going on, everybody? It is Wednesday. You know what time it is. It is Webinar Wednesday with NuView Trust Company. We got a special guest, a special topic, and I am excited to hear from our special guest, Mr. Fernando Angelucci. But first, I have a good friend of mine out in Texas, Becky Crominga with Real Estate IQ. I will tell you, if you are a real estate investor, you are probably not finding your deals on Zillow. You are probably finding your deals or your better deals with services that are provided with companies like Real Estate IQ. Becky, are you with me?
I'm here. Thanks, Nate.
Yeah, no problem.
Happy to be here today. And so, yeah, our website is realestateiq.co. That's not a typo. .com was taken. But what we do is we provide daily updated lists of motivated and distressed sellers that you can contact to get your deals. So we have these different types of off-market leads for you. We have the pre-foreclosure list, Liz pendants, probate, heirship, code violation, delinquent taxes, and we also have divorce. That's a new one that we've added for Florida, is the divorce list. And these ones that have the asterisks, including divorce, you can get as part of our premium package, and the skip tracing is already done for you when you get the list. So when you get the new list every day, added on to the side are phone numbers and email addresses for all of the property owners. So you can just get on them right away and be one of the first ones to contact them. We also have a cool new product, which is a CRM integration. And so that you can manage all of your marketing and keep track of who you've contacted, who you want to follow up with, send texts, make calls, receive calls directly from the CRM, and organize everything in one place. We customize it completely for you. So if you'd like to see a demo of the CRM, or you need more information, or you want to sign up and want a promo code for a discount, contact me. There's my email, becky@realestateiq.co, and you can call or text me at that phone number, and I'll put that in the chat as well.
Awesome. Thank you so much. Yeah, thank you so much, Becky. I will tell you that Real Estate IQ is a phenomenal company to work with. They're always willing to help. I've had only good things that I've heard about them. So thank you, Becky. And you also have your information in the Facebook comments, right? For the people that rewatch it, because we've got about 2,000 to 3,000 people watching the replay. So I think you'll have it there as well, right?
I will make sure and do that. Thank you,
Awesome.
Nate.
Thanks again, Becky. Thanks again, Real Estate IQ. So let's jump into it. I want to get my special guest on here. But before we do that, just a little disclaimer. Before we get into our topic, self-storage and self-directed IRAs. You going to share that? I got my technical assistant, Miss Maggie, over here. Yes, thank you, Maggie. All right. So first, who is NuView? If you're not familiar with what we do, if you're watching this for the first time, we are a self-directed IRA custodian. We're based in Florida, but we offer our services to investors all across the country and even outside of the country. What we do in a nutshell is we provide self-directed IRA accounts, self-directed Roth, self-directed SEP, self-directed HSAs. We've got 7 different types of accounts, including 401ks. That you get to choose your own investments. You're not limited to the stock market and investing in those highly volatile investments in some cases, but you can invest in alternative assets with the accounts at NuView and buy things like real estate. I like to invest in promissory notes, but I always am interested in hearing about other different investment options. I will tell you, I have heard from a lot of different people who are investing in self-storage that they are making phenomenal returns investing in self-storage. So I'm really interested to hear what Fernando has to say today. But remember, when we have these classes, any investment, any advice, it's not advice. We're just giving good education. And ultimately, with the self-directed IRA, you pick your investments. You have the investment choices. The keys are in your hand. We just hold the investment so you get your tax benefits. So we're not providing tax, legal, or investment advice or selling investments. We're just giving you guys some great education. And with that being said, I want to bring in Fernando Angelucci, who's going to give you some phenomenal education. And my ears are wide open to hear because I will tell you, he's from Chicago, great city. Seems like we have a lot of investors and speakers that have lived in Chicago or live in Chicago. So there must be something about that Chicago water out there. But I will tell you, he has invested in just the past 3 years in about $50 million in self-storage facilities. And they currently own well over over 600,000 square feet of self-storage. So if there's anyone better to talk about self-storage, I would say it's Mr. Fernando Angelucci. Are you there with us?
I'm here.
Awesome. Well, I'm excited to have you. Thank you for taking time out of your day to participate in this. I'm just going to turn it over to you. Tell the audience a little bit about what you do, and let's talk about self-storage.
Sure. Let me pull up my my PowerPoint here. All right. So my name is Fernando Angelucci. As Nate said, I'm based in Chicago here, and we've done about 50 million in self-storage deals over the last 3 years. We currently have 600,000 net rentable square feet across the country, with another 500,000 square feet in the pipeline currently. And we're not only focused on the Chicago market, we do invest nationwide. So we're typically finding the majority of our deals in the Midwest, the South, and the Southeast. All right, so let's jump right into it. So why self-storage? So I want to give you a little background on myself. I went to school to be an engineer and graduated, ended up working at a Fortune 50 company, and was not happy with the trajectory that I was seeing for, my career. So I decided to start jumping into real estate immediately. And when I first started, I actually started out in residential properties, both flipping them and then holding them as rentals. And that naturally scaled up into multifamily investments, again, doing both the buy and hold as well as the turnaround projects to sell for some good equity checks. And there was some issues that I was having with my portfolios as I was chasing yield, and that was the trash, the tenants, and the toilets. So as I was looking for a new investment vehicle to get into, I came across self-storage. And what I've prepared for you guys today are the 9 reasons why I like investing in self-storage over any other asset class. So the first is that it's got the highest returns, and we'll go into all these points here shortly. It is a recession resilient asset. Because of that, we have great leverage that is available to us. The management is much easier, and the ability to find deals is also easier because of the fragmented market. It has very low break-even occupancies, or low thresholds to make sure that you're paying your debt service and your operating expenses. Easy evictions, and I'm putting that in air quotes, and I'll show you why here in a second. It has a very high sticky factor. And then in addition to collecting rents, there's also ancillary profit centers that you can tack onto your investment. All right, so number 1, highest returns versus any other asset class. So let's look at the period between 1994 and 2017, where we have some really good data. And what you'll see is the self-storage sector outperformed every other sector that was investing at the time. So if you look at the S&P 500, you're returning about 8% annually. Multifamily did a little bit better at 13%. And then self-storage came in about 4% extra at about 17% return. Now that 4% may not seem like a lot, but if you compound that 4% over 25 to 30 years, you'll see that it creates a major difference. So let's say you had $100,000 to invest in your IRA in 1994, and you chose one of these sectors. So if you put that 100,000 in the S&P, you'd be at about $500,000. If you put that 100,000 in apartment buildings, you'd actually have about 1.7 million. So not a bad return, but look at the difference in that compounding 4%. If you put that 100,000 in storage, at the end of the 25, 30-year investment horizon, you'd be at about $4 million in value. So much, much larger return, almost doubles the apartment investing. The second piece is the recession resilience. So typically you assume that if something has high returns, it also must also have high risk. And what we found was that was not the case. So let's look at the last financial crisis between 07, 09, when there was a lot of value loss across multiple sectors. And this is a study done by the National Association of REITs. looking at each of the sectors. So if you're invested in the S&P 500 during that time, you would have experienced around 22% loss in your portfolio. The apartment space did a little bit better at 7%, and self-storage did the best at 3.8%. Now, this is a study of the REITs. The REITs are large conglomerates. They have a lot of bureaucracy, a lot of red tape. They're kind of slow moving. I know a lot of investors that had storage during that time that fared very well and actually made growth in their portfolio as opposed to losing any. So why is that? Why is storage such a recession resilient asset? And the reason why is storage lends itself to people in transition. So anytime the market is going up, down, you're changing jobs, you're moving to a new home, these are the times that somebody would need storage. So the anecdote I always use is I'm 30 years old and I just visited my father last weekend to hang out with him, and he still has all of my drawings from when I was 3, 4, 5 years old. So what I like to ask people in the audience is, how many of you have children? And how many of you have your children's drawings? If you were forced to downsize and go into a smaller home where you had to select what you were going to keep with you and what you're going to either put in storage or get rid of, how many of you would get rid of those drawings that your children made for you? I'm assuming not a lot of hands would go up. And that was actually the case with my father. He still has a bunch of these large containers with just these little drawings that I made with crayons back when I was 3 or 4 years old. The third piece that I always like to look at is because of the recession resilience and the downside risk mitigation that this asset offers, the banks have caught on to this. And when they're trying to balance out their portfolio when it comes to high risk and low risk investments, they found that self-storage is a really good asset to blend into their portfolios. And because of that, they start offering really good leverage to investors to entice them to bring their loans to them. So let's look at some periods of time and cover a few topics on this here. The first is the default rate between 2011 and 2018, the loss per default during that time, and then why the banks are fighting over each other to give us great loans. So let's touch on the first aspect here, the default rate per asset class between 2011 and 2018. And the reason I chose this section is the financial crisis was between 07 and 09, but what you found was a lot of the assets were not wound down until 2011, 2012, 2013. That's when you had your best chance of buying really good discounted properties. So we took 2 studies done by Intech Solutions and Wells Fargo Securities. And what they found is during that time, self-storage was defaulting at a rate of 40 times lower than multifamily, as you can see. And then when you look at the default rate compared to the average default rate across all of the bank's portfolio holdings, you can see that it was orders and orders of magnitude lower. So the banks see this risk protection on their side and are willing to get more aggressive on the loans to offer and entice investors to bring these types of deals to them. So let's look at the average loss per default. So now, once you know that a investment is defaulting, the bank's very first order of business is try to mitigate the amount of loss they're going to experience when they foreclose or get rid of that property. And what you'll notice is when comparing self-storage to any other asset class, you see that not only was the default rate the lowest, but also the loss to the bank itself was the lowest rate of default. So I know there's a lot of IRA investors in the crowd here that like to lend with promissory notes. And you can do that with single family homes, but you can also do that with self-storage investments. So if you're going to go that route, why not go into an industry where you as the lender have the best chances of success? So here's a case study of a facility that I bought 2 years ago, just to show you how aggressive these lenders were on the terms they were offering us. So we bought this property in Hampton, Tennessee. It's called Hampton Storall. It wasn't in great condition. We had to do, quite a bit of rehab to it, almost $150,000 worth of rehab. When we bought this deal, the bank offered us a 5-year balloon with a 20-year amortized loan. They were acting as a bridge for us before we stabilized the property and then brought it to a non-recourse lender. But as a bridge, we got a 5.25% interest rate and only 1 point to close. So typically bridge loans, you're going to be in the 8 to 9%. If you're a hard money lender with your IRA, so I've known investors that can get anywhere between 10 to 15% interest and anywhere between 3 to 5 points. So this just shows how secure the asset is. The best part too was they allowed us to do interest only payments for the first year. And then here's the craziest part. This was a 0% down loan. So we came in and they actually gave us all the money for the purchase and the rehab and allowed us to come in with no money out of our pocket because they believed in the asset class. So the numbers on that deal is we bought it for $725,000. And after doing the roughly $150,000 in work, it appraised out for $1.2 million. So really great return for us. You know, we added another $400,000-$500,000 in equity just from one deal. So let's talk about the management aspect of self-storage. Coming from the residential and the multifamily side in the past, I thought that was a passive income vehicle. And very quickly, I realized that I had to be working all the time. From there on, then I hired a third-party manager. But then what I found is after I hired that third-party manager, I was still getting calls from the manager when things did not go according to plan. So what I usually ask people is whose passive income is truly passive? I know a lot of investors that have portfolios of single family and multifamily deals where they're working all the time. If you were to ask them to go take a vacation for 2 months with you, turn off your phone, you know, they wouldn't be able to do it. So I always ask, you know, show of hands, how many hours per week are you spending on managing your passive income? And when I was a multifamily investor, I was spending roughly 50 hours a week on my portfolio, in addition to, you know, trying to increase the size of the portfolio itself. So here's a quick case study. My very first self-storage facility that I bought was outside of the Chicago market, maybe about an hour and a half, 2 hours from my home. And it took me about 4 hours a month to manage it. It was nothing special about it. It was a small deal, only 16,000 square feet. But I was producing around $8,000 a year and $8,000 a month in NOI. So 4 hours per month, $8,000 of NOI per month. That means that my rate of return or my rate of pay was $2,000 an hour. That's how much I was making from this facility. And that's very easy to do with some of these smaller facilities that are unmanned or automated. That facility that we had, there's no special bells and whistles on it. It wasn't gated. It had no utilities. It was just drive up, non-climate controlled self-storage that we basically ran from our phone and from the internet. That's all we needed. We didn't even have a manager on site. The next piece is the fragmented market and the opportunity that brings to us. So in 2017, there is a study that estimated there's roughly 52,000 self-storage facilities in the United States. As of today, this number is a little bit closer to 70,000 facilities, between 65 and 70,000. And what's interesting about the storage market is the breakdown of ownership. Unlike the multifamily space where you have a few very large hedge funds and private equity funds that own the majority of the investment grade multifamily, in storage is actually the exact opposite. So 16% or 18% of the facilities in the United States are owned by the 6 largest REITs. These are the real estate and investment trusts. I'm sure you've seen their names around. Public Storage, U-Haul, Extra Space. These are the big guys. Then the next largest 100 operators owned another 9%. This number has gone up slightly since 2017. But in the end of the day, that means that anywhere between 70 to 73% of all facilities are owned by a mom and pop operator. That means they own 2 or fewer facilities. Typically, they're running it more as a hobby or as a second career after they've retired already. And this lends itself to a lot of opportunity in the space as an acquisition specialist or as somebody that's investing in storage for the first time. Now, I alluded to this in the beginning of the presentation, and that's the fact that there's no tenants, no toilets, and no trash. And what that allows us to do is have very low break-even occupancy. So on an unleveraged asset, a property that I've bought with no bank debt, once we got to around the mid 30% occupancy, we were already at break even, meaning that the income itself, only about 30% of the occupancy was bringing in enough income to match the operating expenses. But because this is real estate, we're able to take advantage of leverage and build wealth through that channel. So if you throw some leverage on these assets, then it brings it up to around the mid to high 60% occupancy to cover not only your operating expenses, but also your debt service. Now compare this to some of the multifamily assets that I had in the past, where if I drop below 85% occupancy on a property that had a loan on it, I was already starting to get into the red. So I was already starting to bleed a little bit. And as either a lender or as an investor, the lower you can make the break-even occupancy, the safer the investment is for you. The other piece is because we don't have, those tenants, those toilets, and those trash, we have extremely low overhead. Minimal to no utilities. I may have some utilities running to an office. If I have an office on site, I may have some electricity to light up the facility, but that's about it. There's no HVAC, there's no plumbing, there's none of that. Another thing that I really like that lends itself to low overhead is no turnover costs. So I don't have carpet I need to clean every time somebody moves out. I don't have to paint the walls when, somebody may have dinged it or chipped it or drawn on it. There's no leaky faucets that are costing me money through utilities. There's no winter HVAC failures and no hot water heater failures. So as someone that lives in Chicago, we kind of have the extremes of both. Not only do we have very cold winters where you need to make sure your heating is working, but we also have pretty hot summers as well. So the AC needs to be blasting. And if you're a multifamily or single family investor in markets like that, you know that if one of those things fails on you, it becomes a very quick emergency that you have to drop everything you're doing and go handle that situation. So one of the reasons I really like storage over habitation real estate, or real estate where you have people living or working inside of your assets. So let's look at a case study of the very first facility I purchased, and I alluded to it earlier in the presentation. And this facility is in Yorkville, Illinois. It's outside of the Chicago MSA. Here's what it looked like. It was a no frills deal. When we bought it, the break even was at 35% occupancy. And we actually bought it cash first and then later refinanced and put some leverage on it. Once we put the leverage on it after a couple months of owning it cash, we're at about 81% for occupancy at a leveraged amount. Now, this is a value add deal, so we bought it knowing that we can increase the performance of the facility. Once we stabilized it, increased the income, dropped the expenses, and automated a lot of the roles in the facility, at stabilization, it was 28% for the break-even occupancy unleveraged and 64% occupancy leverage. So this is a perfect example to kind of solidify the point from the previous slides. The next piece, and this was one of the banes of my existence being a habitation real estate investor before going into self-storage, was evictions. There's a lot of states, including Illinois, and a lot of municipalities, including Chicago, that the tenant laws are extremely tenant favorable. And as the landlord, the municipalities look at you like you're this big, bad, investor, and that everything should be going against you. So one of the things I like about storage is that we are not guided by landlord tenant law. We are actually classified under lien law or property law. So what that means is when a customer decides to rent one of your storage units, the second they put their property into your storage unit, they are automatically giving you the right to lien their property in case they do not pay their rent. So what happens if they don't pay their rent? Well, the very first thing is the manager will put one of these red overlocks onto their unit, and it denies the customer access to their possessions until they make their payment. Now, if they decide to not come current on their rent, then all of a sudden we schedule an auction. And that auction is as quick, depending on the state, is as quick as 30 days from the first late payment and to as long as 60 days from the first late payment, which is much better than what you'll experience in a lot of markets for residential real estate. I had a horror story of a multifamily deal that I did a long time ago where the eviction took 8 months to proceed. So really tough, especially now during the pandemic. I know a lot of investors have had eviction freezes placed on them. So they were unable to get rid of unpaying tenants, which is tough, especially if you're a small investor that only has a few properties, because, you know, a couple months without rent, then all of a sudden it's getting hard to pay your own mortgage. So we do not have to face that type of disparity when it comes to self-storage. Now, we've put some circulations in local newspapers or even on the units themselves saying we're auctioning off this facility. Then the day of auction comes. When the auction comes, it's a bid system. So unfortunately, it's not like Storage Wars as you see on TV. Everything is now digital. So all the auctions happen online. And the buyer of that auctioned unit will come in and place a deposit. And that deposit will be kept if they do not clean the unit once they take the possession. So now, not only are we not paying for the turnover, but if the unit is not turned and we have to go do that activity, we have a deposit from the buyer to pay for that. So the turn on these units is super simple because it's a concrete pad and it's corrugated steel walls and doors. So there's not a lot of damage that can be done like in multifamily, where a tenant can, you know, put holes in the drywall or, you know, dump quickset concrete down the plumbing. Ask me how I know about that. You know, cut electrical wires that can cost you anywhere between $2,000 to $20,000 in damage after an eviction. And, you know, good luck chasing them for those damages. So for us to turn a unit, all you really have to do is sweep it clean, or if you have a leaf blower, use the leaf blower to just to blow out the dust in the unit, and it's ready usually same day for the next customer to come in. So the reason we like that is because the life cycle of a turn is typically 30 to 45 days from the date of delinquency. And that allows us to really mitigate a lot of the lost rent that we would experience in, say, multifamily or residential. The eighth factor here is how sticky the asset is, especially when it comes to rent. So here's what I mean by that. If I have a storage unit that rents for $150 a unit, and I decide to increase the rent $20 per month, typically your tenant does not see moving out of the facility to save that $20 worth the $500+ in cost to move to a new facility or to take time off of work or spend their weekend to do that. They'll usually absorb that $20 increase. But if I do that across the entire facility, that is a 13% increase to the bottom line just by sending out a letter. Now, let's look at doing that with a rental property. Say you have an apartment building and your rent is $1,500 a month and you decide to increase your rent by 13%. That's almost a $200 increase per month in rent. You can be pretty sure that your tenant is going to start looking elsewhere, especially because with multifamily, you're not competing with just the apartment down the road. You're competing with apartments in the entire city or the entire area you invest in. Whereas with self-storage, 60 to 90% of your customers will come from a 3 to 5 mile radius around your facility. So there's not a lot of competition that you have to deal with. And then last but not least, in addition to the rent that you can charge for your units, there's all these ancillary profit centers that you can add on to increase your revenue without very much increased expenses. So these are things like car storage, RV storage, boat storage, locks, renter's insurance, moving supplies, packaging materials. You could put a FedEx office in one of your management offices. You can have printing services that you charge for, scanning services. You can put cell towers on your land, which is pretty lucrative. You can put billboard advertisements on your land, also extremely lucrative without much work at all. You can do specialty storage like wine storage, where you can charge 3 to 4 times per square foot than you can for a regular unit. Truck rentals, private mailboxes even. We've had facilities where there's propane filling stations, there's an ATM that you get to collect fees off of, and vending machines. So all these different ways to increase, the multiple streams of income just from one investment itself. So in summary, here are the reasons I love self-storage. It's the highest return of any other asset class. It is recession tolerant. And just a little piece of anecdotal evidence for that point, now we're coming out of a pandemic. TREP, which is a commercial mortgage-backed securities research firm, did an analysis of the loans that were done in the first 3 quarters of the pandemic. And of the 1,700 loans that were made to self-storage operators in that first 3 quarters of the pandemic, only 3 were more than 30 days delinquent. So that's a 0.17% delinquency rate. At that same time, multifamily was defaulting at a rate of 1,800% higher than storage, or 18 times the default rate of storage during that same period of time. Number 3 is that we have great leverage because the bankers see how recession tolerant and how safe this asset is to invest in and to buy. Much easier management. So it's not taking a lot of my time to bring in that same amount of passive income that I would from a residential or multifamily property. There's a lot of opportunities to find good deals out there because it's extremely fragmented market, very low break-even occupancy. So you don't have to stay up at night if somebody decides to move out, or if 50% of your facility decides to move out, you're still doing really well. Very easy evictions. And again, I'm using air quotes for that because we do not do evictions. We actually do auctions because of lien law. That high sticky factor in the ability to raise rents, and then those ancillary profit centers. So you must be saying, okay, Fernando, this sounds like a great investment, but what are the downsides and how do I mitigate them? Well, I actually have a couple slides on that as well. So how do we mitigate the downsides and what are they? The first one is because it's such an attractive asset, such an attractive alternative asset, cap rates have compressed. And so when cap rates go down, your purchase price goes up for the same amount of cash flow that you would have received. And again, storage used to be kind of the ugly duckling, but then all of a sudden, once the big boys started to see how much cash it could actually produce with very little management, then all of the big hedge funds and private equity funds started to get involved into this attractive alternative asset. This creates a pretty competitive acquisition environment, especially if you're going the retail route and you're reaching out to brokers. Brokers have a tendency to strip a lot of the upside out of these deals, and that's what they're there to do. Their job is to get their seller the highest price possible. So what I usually tell people is, if you want to mitigate against this compressed cap rates, you should go off market and buy value add as opposed to buying retail and buying stabilized. So the analogy I like to make is, you have 2 auction houses. They're both across the street from each other. You want to go buy something that's being auctioned. The auction house on the left has 100 people bidding on that item, and the auction house on the right only have 2. Which auction house would you go to get the best price? I would go to the auction house that only has 2 investors bidding. And that's the same thing that you do with retail versus off market. If you go to an off market deal, then you're only going to be usually negotiating with just a seller. There's typically, in our experience, we're the only one at the table, or there may be one other investor, versus trying to buy a deal from a broker. I'm usually competing against 30, 40, 50, 100 investors. Of all of the properties that we bought, the 50 million in self-storage, we've only bought 1 deal from a broker. And that's because he brought it to us before he listed it. And he said, if you get me a full price offer within the next 48 hours, the deal is yours and I'll list it as already under contract. So just things to keep in mind on how to solve for that downside. The other one is this oversaturation, again, because of the large hedge funds and private equity firms that see how great an investment this is. They're starting to come into markets and oversaturate them. And what they're doing is typically trying to stake a flag in a market by grabbing land and building. And storage has very cheap construction costs compared to other assets. When I was building multifamily, it was costing me anywhere between $250,000 to $300 a square foot to build it. And now with increasing building material costs, it's going up even higher than that. But with self-storage, I can build a Class A self-storage facility for $100 a foot, or I can do a conversion project for $60 to $70 a foot, as opposed to that 300 plus. The other thing is that the supply index has been dropping year over year, and the supply index is just a ratio of the amount of storage in a market versus its population. And that is a very important number to see, okay, is this area saturated or is it not? And the solution to this downside is to underwrite and do feasibility studies on your facilities. Self-storage is a very hyper localized investment. So you can't make these overarching generalizations that, oh, the Chicago market is saturated or the Tampa market is saturated. What you have to do is look into the pockets, because again, the trade area is very small, usually 3 to 5 miles in radius. So you can say, well, this 1 5-mile pocket of Chicago is saturated, but if we go down the street, maybe 3, 5, or 10 miles, we may find a pocket that is completely, undersupplied, and there's some good demand that's been pent up. And then, as I've alluded to, the last part that is pretty tough in the space right now is the Reit competition. So REITs are real estate investment trusts. They can be publicly traded, they can be private companies, and they have basically unlimited capital. And that capital that they're deploying is extremely cheap. They're not paying very much for it. The other issue with the REITs is that they have much longer investment timelines than we do as individual investors. They are willing to stake a flag in a market that maybe right now is oversaturated, but they're willing to wait 30 years for that asset to come to full maturation. Whereas me as a self-storage investor, I'm typically looking at deals on a 5 to maybe 10-year horizon that I can go in, I can do the value add, I can force a bunch of equity and appreciation, and then I can capture that appreciation and equity by either doing a cash out refinance and taking all my money out of the project, or going to sell the asset itself. So the solution to this that has worked very well for us is, instead of investing in these primary markets that all the REITs are so excited about, go to secondary and tertiary markets. So as opposed to investing in downtown Chicago, why not go out to the suburbs or the exurbs, or maybe go to some secondary markets around that area? And this has worked very well for us and allowed us to scale very quickly in the last 3 years and build a lot of equity in our portfolios. So that's the end of my presentation there. Nate, I don't know if you have any questions for me. I'm sorry, I wasn't looking at the Q&A box just yet, but I can go back and start answering some if you'd like.
Yeah, no problem. So yeah, and I was going to relay them to you because they're coming in 2 different forms. First of all, great information. I was tied to it the entire time. I like the way that you break it down. It's simple. It makes sense. I'm a no toilets, no tenants guy too, but I do notes. But now you've got me interested in self-storage. I got to admit. So there's some questions
in the storage space too.
Yeah, and I'm going to talk about that when we get to the IRA stuff. So I've got some information that I'll tie in, whether when it comes to how you should look at buying these. If you want to buy self-storage in an IRA, what are some entities that you can use? And then also, some things you would want to consider if you're using your IRA as well. So Frederick Cowan, or thanks for joining us, Frederick. He asks, since the competition is so high, what's the most that gives your facilities a competitive advantage?
Right. So again, it depends on what markets you're in. So not all markets have a bunch of competition. I have a few self-storage facilities where I'm the only self-storage facility in a 10-mile radius. Yeah. So when it comes to dealing with competition, the biggest thing is to be on top of your numbers and making sure that you're constantly updating your market study. So one of the things that we do when we go into a market, what we'll do is a competition study. And in that competition study, we will secret shop all of our competitors, and we'll try to act like customers. We'll try to rent units. We'll call them on the phone, see how long it takes them to pick up. Or even if they do pick up, I'll find a lot of the times, some of these facilities, I'll call 5, 6 times and nobody will answer the phone. The other thing too is looking at what the market rents are, what the street rates are. What you'll notice is a lot of these self-storage owners, these mom and pop owners, they have this kind of mindset where whatever your rent was when you moved in, that's your rent for life. and they may have tenants from 10 years ago. So what we'll do is we'll come in, we'll see what the market will bear, and then we'll immediately start jacking up our street rents, and that will increase a lot of, occupancy as well as NOI. The other things that we'll do is make sure that the facility looks good, it's clean, it's well lit, it's secure. We want somebody to feel comfortable coming to our facility. And we want to just offer as much customer service as possible and make sure that the experience is seamless. So what we do to set ourselves apart is we like to integrate a lot of technology where a customer can rent their entire facility, choose it, get a lock, all from their smartphone or from a web browser, make it as easy as possible and streamlined as possible for them to come in.
Awesome. And what I'll do is a lot of these questions, first of all, guys, keep asking questions. They're great. It's a little specific to your strategies. So while I dip into mine, feel free to go in there, Fernando, and answer, because you can type in answers there, and then I'll take some more questions at the end there. So let's go ahead and share my screen. And I want to tie this into the IRAs. We ready to go, Maggie? I'm just going to share that. All right. Just one sec here, because this is Fernando showed us a great information on self-storage. What's this look like when you invest in an IRA? So first of all, the first thing to know is, yes, you can buy self-storage in an IRA. It's an alternative asset. Most of the alternative assets we hold here at NuView Trust Company are, fee simple real estate, commercial property, land, but we do have a lot of clients that invest in self-storage, and I'll get to kind of how they structure their deals. I'm not here to tell you how you should do it, just kind of tell you the options that you have available to you. But we hold other types of assets. We hold notes. Some of those notes are secured by loans to people who are buying self-storage. So there's a lot of different ways that you could participate in a self-storage investment without actually owning the self-storage asset itself. We also have people that invest in private stock or private entities, and a lot of those private entities own self-storage. So there's so many different strategies that you personally can have with your IRA, of course, where you're participating in a self-storage investment without necessarily owning it, and so forth. But remember, with a self-directed IRA, you get to pick your investment decisions, and you can buy anything out there besides life insurance contracts and collectibles. So I like this quote. I'm sure Fernando will like this quote too, especially when it comes to IRAs. I pulled this straight from a Forbes article where they were talking about self-directed IRAs. And the funniest thing about this article, it was titled something to the effect of self-directed IRAs and the IRS, watch out, they're coming after you. So you would think, oh, wow, there must be something real dangerous with these self-directed IRAs. When you read the article just talks about how the IRS is now looking more at self-directed IRAs because the value of the alternative assets is so much higher than what you see in the traditional IRAs that are holding traditional assets. And here's a couple of the statements that came right from this Forbes article. Is in a study done by the IRS, of the IRAs, individual retirement accounts that are valued above $5 million, 25% of the assets held in those IRAs were alternative assets like self-storage, real estate, promissory notes. But if you look at IRAs as a whole, only 2% of all IRAs hold alternative assets. Those numbers blew me away, even though I was already in the field and I believed in believed in alternative assets. This shows you that the rich and the wealthy are already onto this. They're already buying alternative assets in their big dollar IRAs. So if you want to get away from the rat race of buying and praying that your stocks go up, and Fernando showed us some great statistics as how those have performed in comparison to self-storage from 1994 all the way to 2017, $5 million IRAs are the ones that are holding these alternative assets. So again, it's a great thing, and the numbers don't lie. And then when you look at the types of accounts that you can use that give you tax shelter when buying self-storage or any other type of alternative assets, you've got 7 different types of accounts that you can use. Most people are familiar with the traditional IRA and Roth IRA, and that's about 70% of the accounts that we have here at NuView. The traditional IRA works a little different tax-wise than the Roth IRA. We talk about this in kind of our basics class. You're not taxed going into the traditional IRA, but you're taxed coming out of the traditional IRA. If you're investing in something that's got high returns, like self-storage, or one of the things Fernando pointed out that I like to talk about is compounding interest. If you have the ability to compound your interest, compound your profit, I think there's no better way to do that than in a Roth IRA or a Roth solo 401k or a health savings account or an education savings account, because those types of accounts grow completely tax-free. And if you're compounding your wealth, there's no better way to do it than having it compound and tax-free at the same time. But you could self-direct all 7 accounts that we see here. And most importantly, when you're looking to give yourself more buying power with your retirement accounts, you should be looking at, how do I set up multiple accounts? Because you might be limited to what you have in your own traditional IRA or your own Roth IRA. But if you're looking to buy something bigger, if you need more capital to either buy the investment cash or put as in as a down payment, you might look at partnering your Roth IRA with your spouse's Roth IRA. If you're self-employed, you can set up employer plans that let you contribute up to close to $60,000 a year. Again, another way that you can shelter money away from Uncle Sam. And if you have health expenses, if you're a living, breathing person and you've got an HDHP health plan, stash some money in a health savings account and set up education savings accounts for your kids. There's no limit on how many of these accounts you can have. There's limits on how much you can put in them, but there's also no limit on how much profit you can make tax-free within them. So what I like to do is partner my Roth IRA with my HSA and my 2 nieces' Coverdell education savings accounts, because they all grow tax-free. And that's where you really maximize the use of these accounts that we have at NuView, is identifying all the accounts that you qualify for. And again, it gives you more buying power if you're going to buy things like self-storage or other types of things. So maximize your tax benefits by setting up multiple accounts. And how does it tie into self-storage? One thing that I just want to mention before we wrap it up and take some more questions is, most clients, and again, this is not investment advice, but most clients are not taking their IRAs and owning self-storage directly, for the obvious reasons, right? You probably have some management activity that has to be done there. You're running a staff. You're basically running a business at that point. So from what we see is that most clients who are buying self-storage are treating it like a business, but the IRA is invested into the business, which is held in either an LLC, a partnership, a trust, or even a C corporation. Again, just giving options. I've seen it done a lot of different ways. Maybe Fernando can tell us later how he likes to shelter his assets. A lot of times it could be state specific or whatnot. But the other reason that I want to bring it up too is that, remember, this is a business. So there is one thing that you want to account for, which is your unrelated business income tax. Now, I just taught a class on UBIT, and it was titled UBIT, You Bet. So when people hear UBIT and they hear tax, they automatically get a little hesitant. But UBIT is not a bad thing. Paying a little bit of tax is not a bad thing. Be careful of this smarty pants, maybe CPA or somebody that says, I would never buy that investment in an IRA because you have to pay tax. To me, that's a moot point. It's really about, what's your return. Fernando gave a lot of other reasons as well besides return: recession proof, the fact that you've got no toilets, no tenants, no trash. That all plays into your investment decision. But don't just hear that type of thing. I would never invest in that because I'm taxed. And then what's your other option? Just invest your IRA into the stock market and make less return? It makes no sense to me. So invest in what is profitable, invest in what makes you feel comfortable. Just know going into it what investments are going to be taxed and what investments aren't. So if you don't want to pay the tax, but you want to invest in self-storage, be a lender like me. Maybe find somebody that is familiar with investing in self-storage like Fernando. Not endorsing Fernando because I can't do that. But I would say, if you know somebody like that that you trust, that has experience in the market, and maybe you don't have experience in the market, start off with being a private lender, right? Be a lender to somebody that's buying self-storage. Set up a joint venture and partner with somebody with your IRA. There's a lot of different ways that you can do it and use your creativity. But remember, consult with an entity specialist before entering into any type of investment decision, because at NuView, once you've got the account set up here, we're going to take your instructions as you lay it out. We're never going to tell you yes or no, you can't do that. We'll tell you if it's prohibited or not, but that's really what we're limited to. The keys are in your hand. But if you continue to watch some of these education, and I know Fernando has a lot of stuff on your YouTube channel, you're out there. I mean, your face is popping up everywhere. That you give a lot of good education. And as long as you're an investor that's continually to educate yourself from the right sources, you'll be fine. So that's all I really want to say about that. Just remember, we're always at your disposal. At NuView, there are other companies that do what we do, but I would say that we are probably the most fee conscious when it comes to how much do you want to pay your custodian to manage your investments. So this is just a little graphic done with some little research on the comparison to other self-directed IRA companies. We're anywhere between 20 to 50% cheaper in our fees. Now, we don't pride ourselves on being the cheapest because we don't want to be, we're not the Walmart of the self-directed IRA industry. I would say that we're the Macy's of the self-directed IRA industry. We give the best value. We've been in this business for 17 plus years, highly reputable and highly experienced. So myself, I had come with 10 years experience in the self-directed IRA space. So this is just some considerations to make if you're price shopping or whatnot. You know, we've got some pretty good fees for being your administrator or your custodian. So you can also stay updated with us by subscribing to our YouTube page. I would highly urge you guys to subscribe. We'll also post this video to our YouTube page. Right now, we are the #1 watched self-directed IRA education piece out there. So a lot of good viewers, we're getting a lot of attention. Keep watching, keep viewing, and tell us what you want to watch. I'll give you an email here as well. Tell us if there's any other topics that you want me to cover or guests that we want to have on. I know for a fact after listening to this, I definitely want Fernando on again on a future presentation. Would you be okay with that, Fernando?
Yeah, not only would it be okay with that, depending if you want to do maybe a series, I have probably 10 hours, maybe 7 different modules going from everything from finding the facility, underwriting it, managing it, doing value adds, syndicating it, and raising capital for your deals, all the way to selling and dispositions if you like.
Man, that is awesome. And I think that basically answers almost all the other questions that were in the chat, because it seemed like that's what they were asking. How do you locate your deals? What do you do for that? How do you do that? It sounds like you give a lot of great content. So we'll definitely have you back on. And then also just a reminder, you can follow us on Facebook so you get the live notifications of when we go live, or visit our website, NuViewTrust.com. We do have a promo, by the way. This ends in a few weeks. So if you want to take action now, this is for new clients and existing clients, is email us at info@NuViewTrust.com. We are opening accounts with no application costs through the rest of the month. So if you want to open a Roth for yourself, a Roth for your spouse, a SEP IRA, a ESA, HSA, or maybe you've got 5 kids, you want to open 5 ESAs, all tax advantaged accounts, all accounts that can invest in alternative assets completely tax free. And we're not charging the typical $50 account opening fee. So you can save yourself unlimited money if you're opening many accounts. So make sure that you email me at info@NuViewTrust.com or give us a call and ask to speak with my IRA specialist. So let's get it back to Fernando. Fernando, I want to thank you for joining us on there. Any cascading messages, any last words that you want to tell our audience?
Yes, I tried to answer as many as I could in the Q&A box there, but I did see some coming through the chat function here. There's a lot of really great questions on some of the nitty gritty, the how do I do this day in, day out? And I have a ton of free videos all over the internet. You can find on YouTube channels or Facebook channels. And then if Nate will have me, I'd be more than happy to come back and go through a lot of these videos on the day-to-day, you know, how do you market to them? How do you find them? What resources do you use? How do you manage them? How do you do the value add? Would be more than happy to do that.
Awesome. If we have questions, because I know we're running short on time and there's a lot of good questions, would you rather them email it directly to you, or they can email it to me and I can forward it to you? How do you want to do that?
Whatever's easiest. So I did put my contact information in the chat box here. I also put it on the Facebook post, so people should be able to reach out. I gave my personal cell phone number and my email address. If you want to go directly to me, that's fine. Or if you want to go through NuView, any questions regarding, you know, self-directed IRAs or 401ks and UBIT and UDIF or UDFI, that's going to be more in NuView's purview. They're the ones that can help you out with that. But any self-storage specific questions, that's something that I can help out.
Awesome. Great segue. So if you guys got questions, email Fernando. If you have questions related to the IRAs, you can email me directly at info@nuviewtrust.com. Sometimes it's better to just get on the phone and answer these questions with you guys. So if you want to shoot me your phone number, we can give you a call as well. Again, thank you everybody for attending. Make sure you take advantage of that offer. And thank you, Fernando, for sharing that with us. I was real intrigued, and we're going to do this again.
Thank you very much for having me.
All right, everybody have a good rest of the Wednesday.